In my last video, I talked about selling puts, which is a great income generating strategy that, along with the covered call strategy, which I've also discussed previously, is a great way to make monthly income with low risk. In fact, both selling puts and covered calls are great low risk strategies for anybody's retirement account. In today's video, I'm going to get a little risque, shall we say, and talk about a buying option strategy that is not as safe as either selling puts or covered calls, but has the added benefit of a big profit potential. So what exactly is this big money, risque call buying strategy? It is specifically buying long-term call options, also known as LEAPS. LEAPS stands for long-term equity anticipation securities. And it involves buying call options that don't expire for 1 year or even 2 years. Now, just a summary of a basic options terminology. When you buy a call option, you are receiving the right but not the obligation to buy the stock at a certain strike price. Now, in return for receiving this right, you are required to pay up front a fixed amount of money. And in return for this money, you have unlimited upside profit potential. This is the exact opposite of selling options. I mean, when you sell an option, you get money up front, but you assume an obligation. Here, you pay money up front, but you receive a right that could pay off big time. So here are my rules of thumb for the proper way to buy call options, which admittedly is a much riskier strategy, but I think if you do it in a risk-reducing manner, the risk is worth the big upside potential. The first question is what strike price to choose. Again, let's go back to my analogy of a stock as a plant, a beanstalk, with the bottom section being the roots and the trunk, the middle section being the growth area where there are the branches and the buds, and the upper section being the pie in the sky speculative area where a stock could go to. When I'm buying options, I don't want to buy the roots and the trunk. That's just dead money. And I certainly don't want to buy the speculative pie in the sky area either. When I buy options, I want to buy that middle growing section, the section between where the trunk ends and the branches and buds begin. That's the sweet spot for buying options. So the type of strike price that I would choose is basically where you think the stock is undervalued and solid and going up to its fair value, which would be much higher. So for example, if you have an $80 stock and you think that, rock bottom it's worth $40, then that's where I would pick the strike price for a long call strategy. I mean, why pay from 0 to 40? If that's solid, that's just dead money. Start with the strike price where the growth is actually happening, which would be the $40 strike price. Now, if the stock is currently trading at $60, you will have, $20 of intrinsic value there. The strike price is 40, the stock is trading at 60, so you'll have a good $20 of in the money intrinsic value. Now, maybe you think the stock is worth 80, okay? So you have a lot of growth potential between 60 and 80, and that's where you're going to make the big money in your call option. Now, of course, if the stock goes even higher than 80, you will make even more money, but that's not something you need to count on for this strategy to be effective. Now, as far as the expiration date goes, I've already kind of given that away. I believe in a very long-term expiration when you're buying options. Now, even when you're buying deep in the money options, like I recommend with this strategy, remember we're buying a strike of 40 and the stock is currently trading at 60. So you've already got a deep in the money $20 there. But even when you buy options that far in the money, there is going to be a small portion of time value that you're required to pay. That's just the basics of options, that there'll always be some time value attached. So bottom line, I think buying long-term calls is a great way to have significant upside potential with minimal risk. Now, the best way to implement this strategy is to view these long-term calls or LEAPS as a stock replacement. Now, you could go crazy and buy, incredible dollar amounts of these calls and to maximize potential returns, but I just don't think that's a smart way to do it. I think the smart way to buy calls, because they are inherently more risky than other types of option strategies, is to view it as a way to replace what you would normally have as a stock position. So for example, if you would normally buy 1,000 shares of a stock, you should limit the number of call options to 10, because again, each option contract is worth 100 shares. So 10 option contracts would equal 1,000 shares. So by limiting the number of call options to 10 in this example, you are completely mimicking the gain potential, profit potential you could get from owning stock, but doing so at a much lower cost, which is the real benefit of buying call options. Now, so that's the main thing to do, is to limit your position size to an equivalent amount to your normal stock position. And again, the other ways to minimize risk are to buy long-term call options so that you don't have to worry about them expiring in the next week or two. You'll have a year or two for your investment thesis to play out before you have to worry about early exercise or buying shares that you don't want right now. You can hold on to this option position for a long period of time and not worry about time decay too much. And lastly, you want to make sure that your long-term calls are relatively deep in the money, because if you buy options that are deep in the money, the time value associated with those options is very low. And you won't have to worry about time decay. Okay, so that sums up buying long-term calls, also known as LEAPS. Together with the option selling strategies that I like, covered calls and selling puts, all three of these strategies make up what will be the bulk of the options for income service. Now stay tuned for my next video where I'll explain how I put all of these three option strategies together into my own personal portfolio, and how I go about the decision-making process of which stocks to choose for these strategies and what percentage of my portfolio I believe should be put into each of these three strategies. Now, before I leave, let me just urge you to make sure that you get the options permission you need from your stockbroker so that you will be able to take advantage of these money-making option strategies the minute they arrive in your inbox. Because without setting up your option trading authorizations, you will be left behind. So I urge you to get that done as soon as possible. And with that, thanks for watching.